Yeah, my name is Matthew Unger. I'm the CEO and founder of iComply Investor Services. So what we focus on is multi-jurisdiction compliance automation, very specifically in the area of digital finance, platforms that are looking to engage in global digital finance and cryptocurrencies. So back in 2014, 2015, I've worked on a number of different projects where we started to see e-signatures and a lot of this stuff coming out in the traditional financial markets. And one of the things that you started to realize was the barriers to entry that compliance has for any fintech startup, whether you're a crypto exchange or whether you're an ICO. So there's a number of things in this presentation that I'm going to focus on that are more specific to some of the ICO issues that we see. In 2017, everybody knows, billions and billions of dollars being raised. But what a lot of people didn't realize is the massive overhead, the finder's fees, the success fees, all these additional costs. And a lot of the value that was captured was actually being captured by the advisory services, the transfer fiat to crypto transfer services. And in the case of one ICO that I talked to, they raised $84 million. And they, 9 months later, still had not been able to get that converted back into fiat, or even have a portion of that converted back into fiat, because of some of the money laundering issues and the lack of source of funds reporting they had. So this is very much an area that we focus on. And the issues of compliance are, I'll give you an example. There's a lot of platforms on the first step of compliance is something that we typically call KYC, Know Your Client Regulation. And when you're dealing with something like KYC, it's a very simple question. Who are you, and do I want to do business with you? And if you say yes to that question, you unlock a whole web, as you can see, of issues around compliance. And this has to be monitored on an annual basis, or even periodic if certain types of activities are being fulfilled. The way that exchanges, token issuance platforms, even service providers, the way that they're fulfilling this now is they'll go in and they'll get, in the case of, I'll give you Coinbase as an example, 14 different pieces of software, and it covers, if you look at the Attorney General of New York's report from earlier, or for end of last week, you see that their coverage is only about 60% of what their licenses are requiring them to cover. And that's a big part because they're only addressing the traditional financial risk because that's the tools that were available. So when we came into the market, we said we want to be in this market in an area where we can actually support and enable white labeling, enable, as an example, a lot of the security token platforms in the US now use our system. A lot of the platforms that we're working with in Asia around the exchanges are using these systems because of the efficiencies of scale of boiling in all of these different factors and putting them into an automated throughput. So if you've launched an ICO or ever been a part, maybe just out of curiosity, people in the room, who here has been part of an ICO in the past in any way? An investor or an issuance? Okay, cool. So just getting a little bit of a temperature of who I'm talking to. So when you're dealing with this, especially like last year, there was an ICO that issued locally where they went through and they onboarded using a digital screening tool that's used in like money services businesses, payday loans, online like robo-advisory platforms. They get to the point where they finally have those funds, but now they can't convert those funds over to fiat because they don't know necessarily where did that Bitcoin come from? How do you know if that Bitcoin or that Ethereum or that Dash or that Bitcoin Cash wasn't being used for some sort of financial crime, wasn't from the source of funds from hacking, et cetera. The other thing is the amount of cost to process. So in the example of one of the exchanges that we talked to here in Canada, 80% of their processing is being done manually because the system is only allowing for 20% of the workflow to be automated. That's where you end up in scenarios like this, where the cost of compliance gets exceptionally heavy, and it actually creates a huge burden on innovation in the space as a whole. And so if you want to look at this on a Canadian-wide basis, as of February this year, if you're a peer-to-peer lending platform, a crypto exchange, a bank, to onboard someone digitally, the average cost is $236 per user. That's to do it to financial grade standards. If you wanted to do that, take a look at that, at what is the financial institution, the regulated institutions in the US doing. They're spending 15% of their gross annual revenue because of inefficiencies like this. And so that's only to cover one country. KYC, as an example, in Canada is entirely different. So in the US, you can take a scan of your passport, match it to a photo ID, or match it to a photo, and that's actually something, the first step towards qualifying as a financial grade KYC. In Canada, that doesn't qualify. In places like Switzerland, the workflow is different as well. And so one of the first things that we did when we built our software was the second that we scan that passport, we ask a very simple question: where is this person from? And then as they get onboarded, our client gets documentation to the regulatory standards of that environment, of that jurisdiction. So if you onboard in Canada, you're meeting FinTrack standards, versus if you're in the US and you're regulated by FINRA as a broker-dealer who's doing security tokens, you can actually have your reporting formatted for that jurisdiction's requirements. And so this is done on an automated workflow basis. And this is really where what we've seen, we've done about a year ago now, when we launched the company and actually went live, we released a white paper that really looked at the global regulatory landscape and the things that were evolving and the troubles that people were facing. And most people are familiar with the blockchain dilemma, the scalability versus decentralization versus security. Trilemma. But there's also a trilemma around the compliance of these offerings. And the issue is that this problem really only allows people to go into one of 4 different buckets. They either go fast and loose like 2017, and they hope the regulators don't come back. Unfortunately, they now know that they are coming back and slowly starting to circle through. You have and I would say actually, out of that we have a little over 3,000 projects that went live. We have the hybrid ICOs, which we see 2018 happening, so Telegram. Oh, we're doing an ICO, but it's only accredited investors. And I would argue that one of the big reasons why this technology was so revolutionary, why Bitcoin was so exciting, was the ability that anybody could get in at the ground level. You didn't need to be wealthy enough to demonstrate, okay, this is only for accredited investors. So unless we can solve that, we're not removing any of the inequities in our financial system. And so we see this hybrid approach to say, okay, well, we're going to do this private ICO, or we're going to do what's becoming very common is what they call the Reg D, Reg S combo in the US. And what this simply is they're saying, okay, well, in the US, I'm going to do a Reg D offering, only 2,000 investors. But in the rest of the world, I'm going to file a Reg S. Unfortunately, the Reg S doesn't cover anywhere else in the world. The Reg S covers you to issue to the rest of the world from the US. So you need to observe the regulatory requirements of every jurisdiction where one investor buys into your offering, or you need to just not use that or not accept funds from that jurisdiction. And so this creates a really complex web, and unfortunately, when it's being done on an individual basis, it becomes exceptionally inefficient. So the way that we focused was actually twofold. One, build a white label KYC, AML, ATF solution that automates multi-jurisdiction compliance. The second was enable the token itself to govern the secondary trading reporting requirements. And so we worked extensively on this back in 2016. It was my capstone project when I was at MIT. And over the course of the last couple of years, 2016, let's just say nobody in crypto really paid attention to words like compliance and regulation, nor did they really like you being in the room when that's what you were excited about. That has really changed now, to the point where the cryptocurrency exchanges that we talk to, and they say, well, listen, okay, so this will help us report to FINRA standards so we can get our US BD license so we can trade security tokens. But that doesn't cover Ethereum or Bitcoin because they're not securities according to the SEC, so how do we handle this? And I'm looking at this, 2 years ago you didn't know what KYC meant. And now you understand how to do an SEF filing in order to trade Bitcoin or an MSB license. So the level of sophistication, you didn't have compliance officers a year ago at most exchanges. Now they're formerly banking compliance officers who have deep experience in this space. And the problem is that they don't necessarily have the tools at their fingertips to actually fulfill the requirements that they're legally obligated to as an ACAM certified professional, as a CPA, as a bar passed lawyer. And so these are the tools that we're really bringing into the market in order to serve players. So on the secondary trading, how does it work? This is an example of traditional financial markets. The regulatory perspective, the lens has always been to look at it after the fact, after the trade. An example of this is anything that's traded out as a public security. So you have a stock on the stock market today. You're probably buying it through a broker-dealer account. So let's say I use Interactive Brokers for myself. I can go onto that account, I can find an asset, I can put in an order. Someone else on the other side is fulfilling that order. Then we take a look at that, and that, let's say, is being fulfilled on NASDAQ. NASDAQ takes that and hands that off to a transfer agent and a clearing firm. And that clearing firm looks at all the details around that transaction to make sure it can go through. And the reason why that we do this is, the friction that's caused in these reviews is the reason why we have trade plus 2, trade plus 3 settlement times in traditional financial markets. The scalability of market technology in centralized trading systems is far superior and beyond anything that Bitcoin or any cryptocurrency or blockchain, can do today. But the efficiencies that blockchain enable by having one ledger of transactions that's open and public, where you don't have siloed data sets. So this regulatory scheme, this double checking everything in order for that transaction to go through, and if there's a problem, we're gonna contact Interactive Brokers and get them to roll back that trade and then and get that settled. Well, you can't do that on blockchain. So it's actually technically impossible to actually deal with this issue unless you're EOS, and then you have 16 people voting to roll back trades all the time. It's probably going to be quite inefficient. But the big issue here was this was built back when the securities regulations first came into effect in 1933. And what's the issue with this is this entire concept was based off paper. We've moved on now, and our current traditional financial markets are running on silo data systems. So they basically went from taking papers and moving them from stacks to turning those stacks of paper into silos of data, and everyone's holding their silos of data. Blockchain came in and said the value of a lot of these firms is actually the silos of data that they have. And so, as an example, any stock market, they sell data subscriptions because in real time their data is worth a lot more to a high frequency trader than it is to somebody who gets the public feed 15 minutes delayed. And so the focus around this type of a workflow doesn't fit the needs of what blockchain requires. Unfortunately, I'm not, or maybe fortunately for us, but a lot of the market really felt like, okay, we're going to hold our breath for regulation. We're going to wait for the regulators to make a global, easy to use crypto regulation. We've seen not only the pendulum swing very much the other way, where regulators say, no, existing regulation applies. It looks like a duck, quacks like a duck, it's a duck. I don't care if you called that ICO a currency to access a network. That's not the issue. If you're using this to fund a private venture, it's probably going to be considered a security. If you're allowing it to trade on a cryptocurrency exchange or even on a 0x decentralized exchange, it's probably going to end up being called a security. One of the companies we work with specializes only utility tokens. And one of the functions one of the reasons why we started even considering working with them is they built a piece almost the opposite of our technology, which applies securities regulation. They built it in something called proof of use. So if you want a utility token and you want to be able to trade it, you have to prove that you're actually using this token, rather than this built around this entire speculative model. And one of the offerings that's using that tool right now is called Civil. They're doing an ICO or a token generation event, I guess. But the ability to put those types of pieces in there are actually a massive amount of risk mitigation, and they open up a tremendous amount of opportunity. The way that we address compliance in decentralized finance is very different. Because we're dealing with an open and public ledger, we actually have all the data the second that the request for a trade comes in. So all of the processes of transfer, clearing, settlement, etc., we've boiled down into what we call our patented pre-facto protocol. So this is something that can be invoked live on a blockchain, or it actually can be even pulled from a central trading system like a crypto exchange and integrated into there. So the idea was to be light, to not add latency, and also to enable the ability for transactions to go through the validation beforehand. And this is something that we worked on, like I said, from about 2016 to now, but it was only as of 2017 where this technology actually became something that the market wanted. So, now people are looking at security tokens. Oh, I want to tokenize real estate. Oh, I want to put, I want to tokenize trust units. I want to tokenize this ham sandwich and it's worth $4 billion and I want to do an ICO for it. In all of these cases, the asset that's being created, one, we need to start having some sanity around how we value these assets and maybe bring some fundamentals back to funding private enterprise. But the other piece is these transactions. The regulators, when we, as an example, demoed our system to the Securities Commission, we have written approval to put equity onto the Ethereum blockchain using this system using Ethereum as your corporate share registry, as well as your smart share certificate simultaneously. It's the same data set. And so in doing so, the reason why we have that is because the regulators don't care if your corporate share registry is on a paper ledger. They don't care if your corporate share registry is on Excel. And they don't care if it's on a distributed ledger. What they care about is when you make the transactions, are you following the rules? And so the power that we have with stuff like smart contracts and stuff like automated protocol technology, like our Facto layer, is that you can actually apply this layer to the governance and trading, as an example on Ethereum, to the secondary trade of every single ERC20 token that you engage with. And over time, we'll see about adding different pieces in there. But what does this look like as an example from going to market? You have an idea. I want to launch a cryptocurrency exchange. I want to launch an advisory service to help people launch ICOs. I want to do my own ICO. I want to launch a cryptocurrency exchange or a peer-to-peer lending platform. Right now, you're going to go in, and just to cover about 60% of what we do, you're going to use a bunch of vendors like this. Some of them are still dealing with SOAP-based APIs, which I'm sure there's some people young enough in the room not to really know what that is. They're dealing with very complex systems, high overhead fees. In the case of some of these systems, they're getting a small piece of coverage, and it's fully disconnected. So in the case of a cryptocurrency exchange, you're taking all of these things, you get an engineering team together, you have to build this. Then you have people sitting, in the case of one exchange that we talked with, 100 people sitting in seats, manually processing stuff, passing from one system to another. And there's little pieces of automation between it, but because they're not directly interfacing with the blockchain ledger, the costs and inefficiencies are so high. And so instead, for our system, they're going in, they're using something, one API they're implementing. Secure, data encryption in transit, data sovereignty is observed, GDPR is observed, and you're able to boil this all down. And for a simple SaaS fee, go live basically tomorrow. Get started on your ICO. We did a workshop with a group of entrepreneurs just to test our system out. And everybody in the room, there was the difference between programmer level to what we called grandma level. And the grandma in the room is about 27, 28 years old, but like struggles with smartphone use and still successfully launched their ICO in just over an hour and a half. Live on the Ethereum blockchain, real money being transacted. And so the goal here is not only to bring in things like reducing the burden of compliance, reducing the cost of maintaining compliance, because it's not just about KYC. The guys that are coming at this from the angle of, I'm going to whitelist, and I'm going to create a whitelist contract and do that, don't understand the burdens of dealing with compliance of multiple regulations. Just in Canada alone, you have different rules for BC than you do for Alberta, and it continues on as you go east. And then in the US, it's the same thing, state level. In Germany, it's the same thing, state level. India, it's the same thing, state level. Other countries, thank God, do this on a country-by-country basis. Our current system covers 162 countries, and it's done on a fully autonomous basis. So rather than doing what the banking sector has been doing forever, 15% of their gross annual revenue right now is spent on this stuff. Instead of doing what they're doing and building one landing page for Canada, one landing page for the US, and having to build entirely separate onboarding systems and workflows, you can literally take one API or one widget, paste it into your page and onboard users, feed that into your platform, and now have that ability for when the regulator in Tanzania comes to audit you, or when the regulator in the US comes to audit you, you can filter by that country and say, here's all of the transactions that we've done, generate that as a CSV, and hand that off to your lawyer. And so the idea behind this is not that we're expecting compliance or regulation requirements to go away. In fact, we're seeing it go the other way. Standards are increasing. The requirement of source of funds reporting, as an example, was a major gap in the Attorney General of New York's report on the 13 cryptocurrency trading platforms. Those things get very expensive to deal with if you're not doing it on an autonomous basis. So That's a little bit of an overview of us. I'll skip through some of this stuff specific on the compliance side of things or the workflow side of things. But one of the things that I like to kind of show people is where this is going as a technology and what projects can be funded. One of the very simple things, I mentioned putting equity or your corporate share registry and a smart share certificate on the Ethereum blockchain. What's the difference between these two share certificates? The only difference is one of them is anchored to an Ethereum transaction, an Ethereum hash, and the other one's not. And so the opportunity of what this can enable, if you take that layer and you take the Ethereum virtual machine, and we are agnostic, we don't just work with Ethereum, but that's the one that's we're live in production with, because frankly, I'm sure everybody in the room is probably interfacing a lot with Ethereum. But you look at Ethereum specifically, and you look at, they have their blockchain, they have the Ethereum virtual machine. We layer a pre-facto compliance layer on top of that. And then at that point, you can start saying, well, what other things do I want to invest? If I have an impact investment fund, and I say, okay, well, I want the fund performance, the fund manager's performance to be compensated based on impact rather than just economic return. You can start integrating this directly and autonomously into your smart contracts. So it enables an entirely different opportunity for how wealth is distributed and how wealth is used to fund innovation and ideas around the world. And that's all for me.